Now, it depends how that LLC will be treated tax-wise, depending on what state you live in. So there's two types of states that have to do with like that I guess affect how you file when you're on an LLC with your spouse. So for example, there are states called community property states, and there are states called equitable distribution states. Two types. And if you're in a community property state, for example, California is a community property state. And usually you're allowed the option to where if you live in a community property state and you have an LLC with your spouse, then that LLC is just considered a disregarded entity or a single member LLC when it comes to the IRS. The IRS doesn't consider it a partnership or anything like that. But if you're in an equitable distribution state, which most states are, I believe there's 14. Excuse me. I believe there's 14 states that are community property states. So if you're in an equitable distribution state, then excuse me, I choked there for a second. Then you're considered a partnership if both you and your spouse are on an LLC. What's the difference between a C corp and an S corp? That's a very good question. So, like I mentioned earlier, if you set up a corporation and you do nothing else, like if you just set up a corporation with your state of residence or anything like that, then usually you are automatically considered an S or a C corp with the IRS. Just by default, you have a C corp tax status with the IRS. Now, in order to change that, of course, is to make an S corp election, and that changes your sort of tax structure from a C corp tax structure to an S corp tax structure. But here's the difference between the two. An S corp essentially makes your corporation turn back into a flow-through entity, a pass-through entity. So when you just make a C corp, or just a corporation, automatically like I just said, you're considered a C corp automatically, and you're subject to double taxation. You're subject to both taxation at the corporate level, which means essentially the company level, and you're also subject to taxation at the investor level. So, like the corporation itself pays taxes, and then when those profits are paid to the shareholder as profits, then the shareholder will pay taxes again. So usually there's sort of a double situation when it comes to taxation. But then if you'd like to change that, then you can make an S corp election, and it gets rid of that double taxation, and it turns you back to where you're still considered a corporation on your entity purposes. But for taxes, you go back to sort of a flow through situation to where it's more similar to like an LLC or a sole proprietorship. So those are the two differences. Is C corp, you have double taxation, it's a taxable entity, and an S corp is usually flow through taxation. But here's some of the reasons though why you might want to go with a C corp over an S corp. And one of those is, let's say that you wanted to have let's say that you wanted to fundraise, or have over 100 owners into your business, or 100 shareholders, things like that. Then it might be a good idea to go with the C corp route, because with an S corp you can actually only have up to 100 shareholders in your business. That's just a requirement that the IRS puts on it, to where if you have over 100 shareholders, you can't have an S corp election. But with a C corp you can. So it's usually better for people that are fundraising, people that intend to go public, list their corporation on its a stock exchange, something like that. So keep that in mind. Okay. All right. Are there any S corp specific taxes? That's a really good question, and it kind of depends on what you're talking about. If you're talking about federally, no. You know, in a federal context, there are no sort of specific sort of corporation taxes or S corp taxes that the IRS charges. Now, there might be certain taxes with the state that you're in that will charge S corps. So, for example, New York City, they have what's called a general corporation tax. So, when you make an S corp election, it does sort of, I guess, increase the amount of taxes that you'll pay on either a city or a state level. So, in another state like that is Tennessee. They have certain excise taxes for X corps, things like that. So, really, it depends on your state. And before you become an S corp or before you change your tax structure at all, it's usually a good idea, to speak to some sort of tax professional, like a CPA or something like that, that can run some sort of an analysis. It takes in consideration how much money you're making with your business, what state do you live in, just some other various details about your situation to even see if an S corp is something that would be in your best interest. And we do that here at Collective, by the way, is before you even come on board with us, you'll speak to a business advisor that'll go through your situation, examine your business, and even see if Collective or an S corp would be a good fit for you. How much money do you need to be making before considering an S corp? Well, this is a collective number, what I'm getting ready to say, but Collective says around $60,000. If you expect to net, after your expenses, after everything like that, if you expect to net at least $60,000 in a 12-month time period, then that's generally when we say it's worth it to join Collective and become an S corp. And the reason we say that is because when someone is making around 60,000 and they elect the S corp tax status, people are generally saving around $5,500 in the self-employment tax. And that's why we say that's why we give that income amount, is that if people are saving around $5,500, that right there is a good $2,000 or so, maybe even a little bit more above our fee, for the entire year. So you can say it's a good rule of thumb to say, okay, if I'm at least making this much money, then I can reasonably expect the amount of money that I'll save with the S corp will overcome or sort of overtake the amount that I pay Collective. So it kind of makes it a no-brainer to at that point financially, because it makes sense financially. Now, if you're going to be quite a bit below that 60 grand mark, it might not be time yet. You might want to reassess and wait a little bit. But if you're quite a bit above that 60 grand mark, then theoretically you could save thousands of dollars above our feet with an S corp. And that kind of brings me into my last answer here is, please, if you think that an S corp or Collective or any of that could potentially make sense for your business, schedule a call with us. Go to our website, collective.com. Go to our Instagram, send us a direct message, and you can schedule a call, to speak with a business advisor directly. And like I said, we'll go through your situation, see if you even need to be an S corp. And we'll determine that when we have the conversation. And if Collective isn't a good fit for you, of course, no pressure or anything like that. And we'll give you some referrals that could help you with your situation. And unfortunately, that's all the time that I have today. I actually have a meeting with a prospective Collective member that I got to hop to. But it was a pleasure. I enjoyed it this week like I do every week. And I'll see everyone next week for another Tax Tuesday.